It's a great question. Well, we are advising our clients not to chase this market, but also not to pull back and run away from market either. We have the Fed and trade are the two big catalysts. And the last few days, the market seems to be very much trading on the hopes that the Fed will come in and save the day. But the elephant in the room, and arguably the more important catalyst from our perspective, remains trade. And we really haven't gotten too much of a development there. We did avoid Mexican tariffs, but the China issue looms large. So from our perspective, we expect higher volatility. We expect a period of perhaps some consolidation here. But the meeting at the end of June between President Trump and President Xi is necessary just to get things back on track. We don't expect that to result in a deal. And so the market is going to have to be patient from here.
Josh, the Dow's up nearly 5% for the month so far. We've got a couple of big events to come with the Fed meeting and the G20. Is it hard to see further upside from that 5% June rally until we're through those events?
I'm not sure that I'm the right person to ask about the next 5%, and there will always be the next event that's about to happen and the next event. Here's what I would say. If you're a trader, there are stocks that are making new all-time highs very quietly. We're going to talk about one of them later in the show, very large cap company, well known. But another one is Microsoft. Does not get enough respect. This stock is made a new all-time high yesterday. It's one of the few mega cap tech stocks that is not currently under the microscope and being screamed at by political people. And yet it's very rarely talked about because they don't have a social network that's popular with consumers, and the Xbox maybe is not a big enough part of their business. But that stock is absolutely working. If you're a trader, you're looking for things like that. I'll give you another one, home builders. XHB, very quietly, about to take out a new high, a level it hasn't seen since February of 2018. Who's talking about home builders? Meanwhile, you had this huge backup in rates and in mortgage rates. Maybe that's a space that you're looking at. That's if you're a trader. If you're an investor, everyone's like, what do you do? 1,200 points in the Dow last week. I can't buy them here. The S&P right now is 2.5% off its high, but the Russell is 13% off its high. So maybe that's where you're looking. You're looking at small caps. Maybe they've been hurt more by tariffs than large caps. I don't know what the story is, but if you're an investor, not a trader, and you want to buy something at a discount that hasn't had that run, the Russell is 12.7% off its high. Look at it. Find something that you like. So whether you're a trader or investor, I think there's enough of both in the market right now, and you could find something constructive to do with your money.
I mean, Josh brings up a good point on the record on the 52-week highs. There are a lot of them, and a lot of them are defensive names. Procter & Gamble's on that list. Food companies like Mondelez on that list. Meghan, do you want to stick with what's working in this market, even with stocks trading, some of them near record highs in the defensive space, or go with the other strategy Josh laid out, think long-term, play catch-up in the Russell or the semis or another group that's way off its highs?
Well, I think the movements we've seen in the market does give an opportunity to perhaps rebalance your portfolio a little bit more towards some of the losers. But the market, that's the parts of the market that have led. Well, like your small cap or perhaps even your semiconductors and areas of technology that have gotten hit a little bit harder. But the market has been, by and large, led by some of those more defensive-oriented sectors. So that does give us a little bit of comfort that the market's not overly complacent about the threat of tariffs. But we did increase a little bit more exposure to defensive sectors of late. Your consumer staples, your utilities. But we are also, as I said earlier, we're expecting higher volatility. So within those sectors, there are opportunities. Within your consumer discretionary, maybe it's off-price retail, which could actually benefit from higher tariffs and more inventory at your traditional retailers. Areas of the FANG complex, internet, they are not that expensive, and there's a lot of growth potential there. So we're looking within the sector to more the industry and the stock level to try to find opportunities that might not be as obvious.